Hi, this is Michael Romita, the President and Chief Executive Officer of the Westchester County Association, the leading economic development and business advocacy group in the Lower Hudson Valley. In response to the unprecedented challenges presented by the COVID-19 crisis, the WCA has launched a series of topical video discussions to help businesses navigate through the crisis. Some of our past discussions focused on small business lending and the role of community lenders, the unique challenges faced by the healthcare industry and our regional hospitals, and the invaluable role of the nonprofits during the crisis. Recently, the WCA has launched a post-pandemic working group, which will focus on the long-term economic repercussions of the pandemic and how best to address the economic challenges and opportunities it has created for the professional community. Before we get started, I want to give a nod to our platinum sponsors. We are a membership-driven organization, and our largest supporters make our important work possible. Today's discussion is going to focus on the Paycheck Protection Program, probably the most talked about portion of the federal stimulus package. What it is, and more importantly, if you have received funds, how you can keep them. We have experts from PKF OConnor Davies, a full-service accounting and advisory firm with offices throughout the Mid-Atlantic region that focuses on bespoke solutions and strong personal connections with their clients. Joining me today from their Stamford office are Ron DeSouza, a partner and also a graduate of my father's alma mater, Iona College. Hi, Ron. Good morning. Good afternoon. How are you?
Good afternoon, Michael.
And we're also joined by Bruce. Go ahead. I want to just introduce Bruce. Bruce Blasnick, also from the Stamford office. I have no personal affiliation to his alma mater, but I'll give a shout out to the Binghamton Bearcats nevertheless. Hey, Bruce, thanks for joining us today.
Sure, glad to be here, Michael.
So, Bruce, before we get started, why don't you tell us a little bit about PKF O'Connor Davies and how you're helping your clients navigate through the current crisis?
Actually, what I think Ron, you'll handle that piece, I believe.
Sure, Bruce. So, Michael, thank you for having us, and thank you to the Westchester County Association. So, I'm the Chief Growth Officer at PKF O'Connor Davies. We are about an 800-member CPA firm, accounting and advisory services. We're stretched over about 11 offices in about 5 states. And when I say full service, we provide both accounting and tax compliance services as well as consulting services. These days, we're a little happier about being in the compliance business. But we've been helping our clients all through the COVID-19 disaster relief provisions, and that includes the PPP loans, the economic injury disaster loans, as well as some of the tax programs that are out there. Quite frankly, we've literally helped our clients process hundreds of applications for the PPP and monitored the ever-changing landscape that changes almost on a daily basis. Bruce, my partner Bruce Blasnick, who I started my accounting career with way back in 1981, so we're dating ourselves. You can do the arithmetic. Bruce has been handling the technical aspects of all of these programs for us, and he can comment on that a little bit and the current landscape.
Yeah, it's been a real roller coaster since the end of March when the PPP program was first signed into law, and the law, unfortunately, contains a lot of ambiguity, and the SBA and the Treasury Department have been coming out with announcement after announcement after announcement, trying to clear up some of the ambiguities. Along the way, there's been conflicting information, and unfortunately, some of the most important information we're still waiting for today. That'll become evident throughout our presentation. Some of the questions that are out there, undoubtedly, we won't be able to answer because we just haven't gotten enough guidance. Ron?
Yes. So why don't we start the slide presentation, if that's okay?
Yep.
Ron, before we get into the slide presentation, thank you for putting that up on the screen. Just a couple of quick notes. The first is that you guys have a special section on your website dealing with the COVID crisis, and there's a lot of very useful out there. So if people are interested in looking at that, they can find it at www.pkfod.com. And as you mentioned, we're going to spend the majority of our time today talking about the PPP, how your organization can qualify for it, and how they can get loan forgiveness. And Ron and Bruce are going to walk us through a pretty comprehensive PowerPoint presentation. Before we get into the PPP, I'm just wondering if you guys can spend a couple of minutes talking about the other programs that are available under the federal stimulus. So for companies that were unsuccessful in getting their PPP money, is it too late, and or what else can they do?
Sure. That's a great question, Michael. And I think Bruce and I will bounce back and forth on that. Go ahead, Bruce. Why don't you start?
Yeah, there are a few other programs that are out there. Some have gotten a lot of attention, some not so much. I think a lot of people have heard of the EIDL, or the Economic Injury Disaster Loan. That's out there for people that received the PPP, didn't receive a PPP. There are certain qualification requirements. The application is quite simple. You can apply through the SBA website directly. It'll probably take 15 or 20 minutes to complete the application. Along with that comes a $10,000 grant, or a grant of up to $10,000. The loans there generally have been on the smaller side relative to the PPP program, ranging anywhere from 25 up to the biggest one I've heard of is about $150,000. There are a couple of tax incentives out there as well. There's the employee retention credit. The employee retention credit is available only if you did not apply for the PPP, and it allows a credit of up to $5,000 per employee. And slightly different rules depending on whether you have more than 100 employees or fewer than 100 employees. Another program that's quite popular is the employer tax deferral, where you're allowed to defer payment of the employer FICA taxes for the balance of the year, and the payments that are deferred become due and payable at December 31st, 2021 and December 31st, 2022. That's a big savings. It knocks about 6% off of every payroll you run. Main Street lending program is out there as well. We haven't received a lot of information about the Main Street lending program. It's generally for larger companies. There are some minimums involved in terms of qualified loan size. And you can qualify for the Main Street lending program even if you received a PPP loan. Ron, anything I missed?
So, Bruce, on the economic injury disaster loans, I just wanted to point out that those are loans that are processed directly through the SBA. So as opposed to the PPP program, where you apply for 2.5 times your average monthly payroll, the economic injury disaster loan, and when we say disaster loan, that's a program that was formulated for declared disaster areas in the United States. So very often we hear about that when there's been a hurricane or a tornado, but what you do is you apply for that loan, and then a loan officer from the SBA determines what your damages have been and then offers you a loan amount. So, Bruce, I know you said the largest you heard of was $125,000, but I actually had a client that received a $500,000 EIDL loan, and the rate on that loan is 2.75% for not-for-profits and 3.75% for businesses with a 30-year maturity. So the payments on that can be pretty attractive. The interest rates are fine, but knowing you can pay it back over 30 years with favorable eligibility criteria do make that attractive.
One additional point that I want to stress is what Bruce said about the employee retention credit being something that is you can't apply for both. You can't get the employee retention credit and a PPP loan. Right. But in the case of the employment tax deferral, there's actually nothing to apply for. You just take the deferral when you're ready to send in your remittances. Is that correct?
That's correct. I'm not sure exactly how it works. I know there's a Form 7200 that you have to complete. I believe that Form 7200 is so that you can actually get a refund of the money. If all you're doing is taking a credit against your employer taxes, Mike, I believe that's correct. You just take the credit on your employer tax form 941 on a quarterly basis. I know the payroll companies are working closely with their clients on that on that credit, and there's special coding, I believe, that needs to be completed. So if you're interested in that credit, and there's no reason you shouldn't be at this point, reach out to your payroll provider, and they can probably provide you with the guidance needed to take the credit using their systems.
Thanks, Bruce. That's important to recognize. But of course, the reason why so many people are focused on the Paycheck Protection Program is because if it's administered properly, it's forgiven, and it turns into essentially a grant. Even though, you know, a 1% loan for 2 years with deferred interest is pretty attractive, free money is even more attractive. So you guys have this pretty comprehensive PowerPoint presentation which you're going to jump into now. And I'll just remind our viewers that if you have some questions that you want answered, please post them and we will get to them as time allows. And I'll turn it over to you guys now. Thanks.
Thank you, Mike.
Thank you. So, Bruce, can you advance to the next slide? Okay, so today we're going to cover 4 main topics. We are going to do just a basic overview on the PPP program once again, just to refresh everybody's recollection as to what the provisions are. And then we're going to take a look at some of the latest statistics on loans that have been granted. We're then going to take a look at the requirement for certification of need. And as we discussed before, it is an ever-changing landscape, and there has just been some new guidance that has come out on that yesterday and today. And when we get there, Bruce and I will comment on that. We're then going to move on to review the rules related to loan forgiveness, and we're then going to wrap up with some planning considerations. So, and there's a lot of material here. So what we do, we encourage people to, if you can, to take a download of the slides presentation for future reference, and we'll, because we may move through some of the materials a little bit quickly to try and stay on schedule here. Next slide. Okay, so next slide. Okay, so just to do a refresher, the Paycheck Protection Program is actually part of the CARES Act. CARES Act being Coronavirus Aid, Relief, and Economic Security Act. I'm assuming we have an employee in the federal government who's paid someplace to come up with these imaginative acronyms. And as we've already discussed, it provides forgivable loans equal to 2.5 months of average 2019 payroll costs, with a maximum of $10 million per entity and $20 million per affiliated group. Obviously, the key word here is forgivable loans. It's generally meant for small businesses, businesses of 500 or fewer employees, or who meet the definition of small business according to the SBA definitions. It's also meant for 501c3, which are charitable organizations, and 501c19, which are veteran organizations, also with 500 or fewer employees. The loans can be used for qualified payroll costs, and we will go into a discussion of that later, what is included in qualified payroll costs. Loan, rent, and utilities. Amount not forgiven is repayable over 2 years with interest at 1%, and there's a 6-month payment deferral. So there's no payments for the first 6 months. And we're going to talk about that because part of the planning considerations, you could decide to take some of the money and keep it for 2 years and keep it as a 1% loan if that's in the best interest of your business. But obviously, once again, you're going from forgiven to a loan. So, but once again, part of the planning considerations. Last bullet, there's been $660 billion authorized in 2 tranches of funding. As I pointed out, it's really $659 billion. But when we got this high, we did not think a $1 billion rounding error was that substantial. So, all right, next slide. It's also we're also although the loans are processed and dispersed by banks and other lenders, it's still essentially administered by the U.S. Small Business Administration. Somebody, I don't know if it was Bruce or Michael earlier in the call, talked about one of the interim rulings that have come out. So the SBA continues to issue interim rulings. Don't be confused by the word interim. They're only interim because they've not yet gone through the proper comment period, but I doubt they're going to change. It's not a new program. The Act temporarily amended existing SBA business loan program under Section 7A of the Small Business Act. There's relaxed underwriting requirements and expanded eligibility. And the title of the Act is Keeping American Workers Paid and Employed. And that's part of what we're going to talk about today. Clearly, the title kind of says it all, right? This PPP, as we're going to it, as is meant to keep American workers paid, whether they are on the job or whether they are sitting at home, so to keep them working and employed. So the PPP loans to date, so round one, which was authorized at $349 billion. Right now it stands at about $342 billion, and that's fully committed. $7 billion disappeared. We don't know why. We're thinking that may be fees that have been paid to the banks. But kind of interesting, the average loan size under round one was about $206,000. In round two of the $310 billion, which has been committed, $189 million basically has been funded. And you can see that the average loan size went down from $206,000 to $73,500. Make your own conclusions about this, right? We've all been reading articles in the press as to who's been receiving loans, what banks they've been receiving them from. Did the large banks take care of their larger customers first? Are there more community banks in the second round? We know that self-employed individuals, independent contractors applied in round two, so that may account for some of the smaller loan sizes there as well. But in total, $531 billion of the $659 billion has already been committed.
Ron, the other thing to step in here real quick, the other thing that that stands out here is there's still money in the program. When the first tranche came out, that money disappeared. It was fully submitted in about 8 days. The second tranche, which added another $360 billion to the program, has been working its way through the system more systematically. So if people haven't yet applied for the PPP money, there's still time to get their applications in.
Yeah, and Michael, just a little public service announcement here, but we've I think it is the more established businesses, the well-run businesses, all know about the PPP program, and I would say in the last couple of weeks, I've been on the phone with friends, relatives who are independent contractors, people who do a Schedule C on their 1040, get paid on 1099s, and it's amazing how many of those people were unaware of this program. So as you speak to other people that that really truly may need the help to get through this tough period, please remember to mention to people that this PPP program is available for independent contractors and sole proprietors. It's a good thing.
Yeah, I'll add to that, Ron. The program is far from perfect. There are a lot of issues, and there have been a lot of complaints about the way it's been rolled out and some of the rules. But if you're in a business that's taken a hit because of this pandemic and you're looking for capital to help get you through, it really is a great program, and it's still out there, fortunately, for the taking.
Great. So if we could go back to the slides. Okay. We go to the next slide. Okay, so now we're going to move on to discuss the requirement for applicants to certify need. So, Bruce, this is probably a good time to talk about the current landscape, which has been evolving over the last couple of days.
Yeah, so about 10 days ago.
Well, let me go through this slide first.
You want? Okay, go ahead. Sorry about that.
Yeah, so no, it's okay. It's my fault. But you could see the time. We started to put out some of the timing in the slide. But the first bullet, which is most important, is that every borrower on the application needed to make a good faith certification that, quote unquote, the uncertainty of current economic conditions makes this loan request necessary to support the ongoing operations of the applicant. When the program first came out, discussions all around the business community were, you know what, this is kind of a loosey-goosey just certification. It's kind of the Wild West. They're really just out there giving money, and you really don't need to worry about this this certification. I even talked to some attorneys about it and said, you know, what is the exposure of a business signing this certification? And they basically said, you know what, listen, this is a very low bar. You really don't need to worry about it too much. But then as the weeks progressed, a lot of information came out in the press. A lot of people may have seen that. The first one was Shake Shack. Shake Shack, based on the provisions of the loan, was definitely qualified to get PPP monies, but public pressure on businesses like theirs, Ruth's Chris Steakhouse, Harvard University, hedge funds, private equity funds, all resulted in kind of a backlash where these companies really did want to consider giving back the money, and accordingly, the SBA started to issue some new advisories, some new regulations as to what should happen with that. So Bruce, now I think that's the perfect segue for you to talk about what the current landscape is.
Yeah, so what ended up happening is the SBA came out with this safe harbor. They gave until May 7th for the businesses to assess their need and return the funds. Then, but people were up in arms because they didn't know what standards. I think we covered some of that on the next slide. They extended the safe harbor date from May 7th to May 14th. And they said that they were coming out with some additional guidance to provide borrowers with some information about how this need was going to be assessed. Unfortunately, the 14th is today, so the safe harbor date ended today. They came out with the information yesterday mid-morning. Very few people had time to respond to it. It was a favorable ruling in that they came out and they said that if you're a borrower with under $2 million, we're going to just assume that you've certified in good need. We're not going to really address it from this point on unless we see some kind of real abuse or fraud in the process. If you're a borrower of over $2 million, which I believe Michael said at the onset, over $2 million, these funds will be audited. They're going to look at every loan over $2 million. They're still going to look at your assessment of need, and if they determine for whatever reason that they don't feel you had the need, they're going to ask you to repay the loan. As long as you repay the loan, they'll leave you alone from that point forward. And this is quite a step back from what they said initially. They were really threatening people by saying, you know, if you've taken this loan and you shouldn't have taken it, you could be subject to criminal liability with up to 30 years in prison. And people were really up in arms. So they backed way down with this announcement that came out yesterday. And then just this morning, they extended that safe harbor date to Monday, May 18th. Now, you know, quite frankly, I don't really understand why anybody would give back the funds at this point unless they feel they were really abusing the rules to begin with. Because they already said there's no criminal liability, and the worst case scenario is that you have to pay back the loan. So why not hold on to it by chance they might let you keep it and worst is you pay it back later instead of now. Ron?
Yeah, Bruce, it's a really good point. It's a really good point. And speaking as a recovering attorney, I still hold my license, but I'm not qualified to give legal advice anymore. But basically, a safe harbor means if you comply with the rules and you give back the money because you shouldn't have self-certified the need, no questions asked, as long as you do it by the time the deadline passes.
That's correct. It's as if you never took the loan in the first place. They're giving you an absolute free pass, and in fact, you still qualify for the employee retention credit that we spoke about earlier. Whereas otherwise, if you have a PPP loan, you don't qualify for the retention credit. That might be a reason I suppose, to give back the funds if you feel there's a good chance you'll have to pay it back and you want to take advantage of that credit.
Okay, Bruce, can we go on to the next slide?
Yeah.
Okay, so we are going to talk about our recommendations. So based on what we've seen in terms of justifying need, and once again, this is most important for entities that have taken loans of over $2 million and are concerned about that about the clause that they signed saying to the necessity of the loan. But we think you should be preparing projections which go out as long as you believe the pandemic might have an effect on your business. So, most people are thinking projections of 6 months through a year. Your projection should be based on the facts that were known as of the date that the application was submitted. So, right, because you're signing that representation as of the date of the application. You could have only known then what you knew then. The fact that you may have gained additional information as time went on should not really be relevant. In doing your projection, assume that the 2019 payroll levels will be maintained for at least 8 weeks or through June 30th, 2020, which really is the intent of the act, regardless of the volume of business that you're bringing in. So once you've done that, once you've gotten past that June 30th, 2020 period, you may want to right size your payroll based on what the needs of your business is and based on the volume of your business going forward. You should also consider other sources of liquidity, including cash on hand, investments, reserve, and quasi-endowment funds. That's for not-for-profit organizations. Quasi-endowment could be board-specified, board-restricted funds. Take into account pay reductions for highly compensated employees, elimination of bonuses, business profit suspension of dividends or distributions, available lines of credit, and owner resources. So once again, we believe you should probably prepare a couple of different projections based on different fact patterns to try and demonstrate your need for the loan. Last bullet: document the key uncertainties that existed, how you interpreted necessary, what would be detrimental to the business, and other key considerations. So, we think once you've done the projections, I think you need to really look at the amount of cash you have on hand. You need to see how the business is looking once the projection period is over. Once the projection period is over, is it a healthy business? Is it a business that may not make it through the projection period? Obviously, if the challenges are there, if cash is king here, right? So if you get to periods in which the cash may not be able to sustain the business, you've probably demonstrated a need. You can also consider this slide 11. Consider the possibility of partial need. So everyone knows that when you applied for this loan, you applied for 2.5 times the average monthly 2019 payroll. And now the fact is that your business may have required less of a loan than that. Based on the projections you put together, maybe you don't need 2.5 months. Everyone who's done the applications, however, probably realizes that the applications, which were put together very quickly by the banking community, did not necessarily allow you to request less than 2.5 times. But if you don't need 2.5 times, you could always return some of the funds. So we give an example. If you were planning a 20% reduction in force for 6 months, but you take the PPP loan to avoid a reduction in workforce, this would equate to approximately 1.25 months of payroll rather than the full 2.5 months. So the remaining half of that, you can either return the monies or you can take it as a loan for the next 2 years at 1% interest rates. And then our caveat on the bottom, which seems to become truer and truer every day as the rules change. So we think you should deal with these issues. The other recommendation we did not put in here, Bruce, that just came to mind is, as these applications were done, sometimes it could have been a controller, it could have been a chief financial officer, it could have been a treasurer that signed the representation in the application of financial need. As a best practice, we would also recommend that for every business, there should be approval documented on paper that the entire board approved filing of that application. When that whole criminal liability thing came up, there were CFOs and controllers who had signed that thing and said, "Oh my God, I don't want to go to jail." So share the responsibility. Bruce, anything to add on that?
No, I think you covered it pretty well, Ron.
Okay. So
Okay.
so next slide 12. PPP loan forgiveness. We were going to go into the calculation, the nuts and bolts of the forgiveness calculation, which is incredibly important to everyone who took a loan. And this is going to be my opportunity to turn it over to Bruce. And Bruce, as you go through it, Michael and I will get to ask you the hard questions.
Very good. Thank you, Ron. Certainly over the past couple of weeks, most of the questions we've gotten have been focused on two areas. One is the needs assessment, and the second area, which seems to be most of the questions these days, is focused on loan forgiveness. So let's take a look at the basic loan forgiveness calculation. On the surface, it's a pretty straightforward calculation. It's the eligible costs you incur in the 8 weeks, and I want to emphasize that's 56 days, beginning with the date you receive the PPP loan funds. That's the date that the funds actually hit your account. And you multiply the eligible costs by your employee retention rate, which is the ratio of your FTEs or full-time equivalent employees during the 8-week forgiveness period to the FTEs during a defined base period, and we'll cover that in more detail later. Now, for most borrowers, quite frankly, that's pretty much it. It's the amount you spent that qualifies for forgiveness multiplied by this ratio. However, if you cut the pay of any one or more employees by more than 25%, you may need to determine what is called the excess wage reduction, which is a confusing concept. But again, this isn't going to apply to most borrowers. I also want to point out at this point that some people have interpreted the PPP guidance to require that 75% of the entire loan amount must be spent on payroll during the 8-week forgiveness period in order to qualify for any forgiveness at all. In essence, what they're saying, it's a binary decision. You either spend the bulk of the money on payroll in 8 weeks or you don't qualify for any forgiveness, period. While we and many others don't interpret the guidance that way at all, if that were the case, why would we even bother with the FTE ratio and excess wage reduction calculations? These things wouldn't matter at all if the money was all spent in 8 weeks. So we don't believe that this binary interpretation is the correct one, but there's probably needs to be some clarification on this point. And it's unfortunate that we're sitting here at this point, given that a large majority of businesses have already received their PPP loans and they're already spending the money. This seems to be par for the course, however, as we'll see in a minute. It seems to be spend the money now, learn about the rules for spending it later.
Yeah, I'm going to jump in here real quick and make a few salient points, Bruce. And you're going to get into what a payroll cost is in a couple of slides, because it's not just salary. It's also some element of the benefits. But the 75% rule that you just touched on has become a bit of a flashpoint for some small businesses. I was watching a hearing before the New York, a joint commission of the New York State Legislature, the Senate and the House, talking about how this was impacting small businesses. And for many businesses, bringing back employees right now where no customers are going to show up to shop or eat at a restaurant, for instance, is not particularly helpful. So these small businesses were looking for some additional flexibility for how the loan money could be used and still qualify for forgiveness. This is something that may be addressed in the next round of stimulus, or it may be addressed by some future interim rules that are promulgated by the Small Business Administration and Treasury. Because they weren't, these rules are rules that were not necessarily included in the language of the legislation, but are really interpretive rules that are coming out of the administration.
Yeah, that's right, Mike. And that 75% rule has been quite controversial, as well as the 8-week rule. And I'll touch on those things a little later in the presentation. But I want to point out the 75% rule that I was referring to is there are actually some people out there who have interpreted the rule to say that 75% of the entire loan must be spent in the 8 weeks on payroll. Now that's not, that's difficult. Even if you haven't let any employees go and your business is running quite full. In fact, I've run the math, and unless you give people raises or increase your headcount, you actually can't hit that 75% number. There's controversy on a number of things related to different 75% rules. What I want to get into now, we talked about this. The first point on this, the first part of the equation is the eligible amount. So what I want to talk about is what costs are eligible. It seems to be pretty straightforward, and most people seem to have a pretty good awareness of what the parameters are. The amount eligible for forgiveness is equal to costs incurred and payments made for payroll costs, mortgage interest, rent, and utilities. And then this 75% rule, which came out, as you said, not in the original act, but in interim final rule number 1, came out on April 2nd or April 3rd, stipulated that 75% of the amount forgiven has to be used for payroll costs. Before I go any further, I also want to take this opportunity to point out that there's a big question out there for some nonprofit organizations or other businesses that have grants or contracts with the federal government. There's a question whether the costs covered by those grants or contracts are going to be eligible for forgiveness. After all, it doesn't necessarily make sense that the federal government will be reimbursing you twice for there may be some similar issues with state cost reimbursement contracts and whether you'll get some state pushback on these costs that are being reimbursed by the federal government. But at this point, like so many other things, we're still waiting for guidance on this. Okay, now what I'd like to do is go through each of the cost
Bruce,
categories. Yeah, go ahead, Ron.
And just as a corollary to that, we've also had some questions for not-for-profit organizations as to whether the proceeds of the PPP loan will be subject to federal single audit. And the guidance that we've gotten is that it is not subject to federal single audit. Right. If you did get a disaster loan, economic injury disaster loan, that would be subject to single audit.
Yeah, that's correct. That's correct. That's an important point. Thanks. Okay, first costs, payroll costs. Most people by now probably have a pretty good handle on what's included in payroll costs. I know there was quite a bit of confusion early on, but these are the same costs that were used to determine your PPP loan amount. Salaries and similar compensation, not to exceed $100,000 a year or $1,923 a week for any individual employee. Payments for vacation, parental, family, medical, or sick leave are qualified as well. Group health insurance premiums, but you have to be careful on that one. It's only the employer's portion of the group health, not the employee portion, so you have to back that out if there's a copay by the employee. And also, a lot of these group plans have life or disability or other types of insurance mixed in. It's only the group health. We're assuming group health includes dental and vision, but we're not 100% sure about that. Retirement benefits for employees, again, includable, but it's only the employer's share of those. State and local taxes on the employee wages. In New York State, you have state unemployment insurance, and if you're in New York City, you have the New York City MTA tax. Disability, the state-required disability, and the workers' comp, those are not taxes, those are state-mandated insurance. And if you're a self-employed individual, a sole proprietor, or a partner in a partnership, your self-employment income is also includable as a payroll cost in an amount not to exceed $15,385 for the 8 weeks. And that's $100,000 a year is what that represents.
Bruce, I'm going to jump in quickly with a question relating to this that's come up.
Yeah.
The payroll that complies is up to $100,000 plus the associated benefits. Now, if you have an earner or an employee who's making greater than $100,000, do you also prorate the additional benefits, or do you just tack those on the top?
Yeah, so the SBA came out with some clarification a few weeks ago on that point. One of the points there was a lot of confusion over. So it's the salary up to $100,000 plus the benefits. So you don't have to prorate the benefits at all. The benefits are includable just like they would be for any other employee. The one exception to that rule is if you're self-employed, you're filing a Schedule C, or your income is reported on a K-1 from a partnership, your benefits cannot be added to the payroll costs. It's only your self-employment income up to the $100,000 a year, or $15,385 for that 8-week period.
Thanks for the clarification.
Bruce, if I could touch on the self-employed for 1 second. You know, some people have said, well, if I'm self-employed, how do I have a payroll cost, or how do I pay myself? Well, just the fact that you're self-employed and you make up to $100,000 a year, you would basically take a distribution for yourself, just like you would if it had been your own money coming through the business.
That's right. That's right. And what we're actually recommending is that you cut a check from whatever account you're using to make your business deposits into some other bank account, just so that you can show that you paid yourself. You can do that, weekly or semi-monthly or monthly during that 8-week period. But it's a good idea to have an actual check to show that you paid yourself, because I think some banks are going to be looking for that on the back end. So now let's talk about other costs that qualify for forgiveness. First, we have interest on debts secured by a mortgage on real or personal property that were in place prior to February 15th, 2020. But what's a mortgage on personal property? A lot of questions on that. There are some states that use what are called chattel mortgages to secure loans on certain movable equipment. So it's possible that that's what the Act was referring to. However, in interim rule number 3, the SBA uses an example to explain interest as the interest on your mortgage for the warehouse you purchased, or the interest on an auto loan for a vehicle you purchased for your business. So absent guidance to the contrary, it seems that equipment loans secured by the equipment acquired with the loan proceeds are considered mortgage interest for purposes of forgiveness. What about other loans, though, like lines of credits that might be secured by all assets, or term loans that are secured by all assets of the business? Again, no clear guidance on this, but since the loan proceeds in that case were not used to acquire the equipment that secures the loan, I think it's probably not going to count. So I would not include interest on general purpose loans secured by equipment in your forgiveness calculation. Next up, we have rent.
And distinction here. Sorry, Bruce. The salient distinction here is you're talking about interest specifically, not principal.
That's correct, Michael. The interest, it's only interest payments. You cannot use the PPP loan proceeds to pay down loan principal. Correct. Next up, we have rent, and a lot of people early on, and perhaps even today, assumed that what was being referred to here was rent for real property, like your office or your warehouse. But again, in interim final rule number 3, there's an example where vehicle lease payments are considered qualified rent, and the Act itself never says rent for real property. It simply says rent. So rent payments for real or personal property are forgivable as long as the lease agreement was in place prior to February 15th, 2020. What about related party leases? Again, there's nothing in the Act or any other guidance that excludes rent on related party leases. However, if there's not a written lease agreement that was in place prior to February 15th, 2020, you could have an issue trying to prove the validity of the related party lease payments. And last up, we have utility payments for services that were in place prior to February 15, 2020. So again, if you moved into a facility recently or you changed service providers on, say, March 1st, 2020, unfortunately, those utility payments are going to be excluded. Utilities, just to clarify, it includes electricity, gas, water, telephone, internet access, and transportation. Some people have asked about things like trash collection. As far as I know, trash collection is not a utility service. Cell phone contracts, on the other hand, absent further guidance to the contrary, probably are forgivable. I had someone reach out today and ask about security costs. I don't know if they were referring to physical security like security guards or an alarm service, and they thought that probably qualifies as a utility as well. I'm not sure. There's no definition given to that, and it's certainly not includable as one of the stated items in the Act. One thing that sticks out here is transportation. It's kind of an odd inclusion, and a number of people have asked about this. So I went ahead and looked it up, and there are certain metropolitan areas around the country that treat transportation like a utility. I'm not sure exactly how this differs from a tax, other than maybe the charge is based on usage rather than some other basis. But given this, I would say that employer-paid costs for regional transportation services are probably forgivable as a utility costs. Some groups, including the American Institute of CPAs, have surmised this might even include fuel costs for company vehicles. I'm honestly not sure how this qualifies as a utility, so my best guess is that vehicle fuel costs are not considered a utility. Okay, and now for the million-dollar question. Are costs determined on a cash basis or an accrual basis? And unfortunately, we still have no guidance on this issue. I suspect that the answer to the question is neither, at least not in the way an accountant thinks about cash basis or accrual basis accounting. The Act uses this phrase, costs incurred and made. There's been no attempt whatsoever to clarify what this means. And this is despite the fact that some companies have had their PPP loans for a month now and they're already spending the money. The phrase insinuates that expenses have to be incurred, but not necessarily within the 8 weeks, just incurred, so you can't prepay expenses, but that they also have to be paid within that 8-week period. So for payroll, for example, the payroll that hits your bank account the day after you receive the loan probably counts as a forgivable cost, since it's for payroll costs that have been incurred, although not necessarily accruable to that 8-week period. And it's being paid within that 8-week period. At the other end of the 8 weeks, however, you might have a payroll that's accruable to the 8 weeks, but it's paid a few days after that 8-week period ends. My guess is that probably won't count. The reality is that's all okay as long as you're a weekly or biweekly payer, because you're going to pick up 8 weeks of payroll no matter what, no matter when the start date and end date is. But this concept of costs incurred and payments made does create some significant issues. If, for example, you run your payroll on a semi-monthly basis, no matter what, you're only going to have 3 pay dates that fall within that 8-week period. And then we have things like health insurance and office rent, which are generally paid monthly in advance. But if you can't prepaid expenses, then how would these count as a forgivable expense? So what we're anticipating, there's going to be some type of a modifier or clarification on this incurred and paid requirement. It'll be something like amounts due and payable within the 8 weeks will be forgivable, or 8 weeks worth of rent, 8 weeks worth of health insurance, 8 weeks worth of payroll. In the end, that's what really makes the most sense. I don't think they intended to include these things, but again, with the awkward wording, we just don't know. There are also other questions that can arise with this awkward wording or the lack of guidance. What about the March and April rent that your landlord allowed you to defer? Now, these costs have been incurred, so if you pay those costs within the 8 weeks, along with the regular rent that comes due during that 8 weeks, can you get credit for 4 months of rent? And what about, say, the 2019 profit sharing plan contribution that isn't due until you file your 2019 tax return in September? If you pay that now, can you get credit for the entire amount as a retirement contribution during the 8-week period? Or should you pay some pro rata portion of your accruing 2020 requirement contribution? We're in the unfortunate situation, again, of not being able to answer these questions right now, but I suspect it's going to be more in line with 56 days worth of retirement contributions being that accrue in the period, as opposed to being able to take a big lump sum all at once.
Bruce, we have a couple of questions coming in that I'm seeing being fed to the Facebook feed, so I'm going to throw a few out at you. I just want to remind the viewers that this entire presentation will be made available through a link on our Facebook page, www.westchester.org, and we'll also link it to the replay of this video on Facebook, and I believe also on YouTube, and of course, people can also find it through the PKF OConnor Davies website. One of the questions that's come in is, if an organization is renting a facility, but in addition to that, they are paying a facility fee for the use of other facilities, can that be factored into the calculation for loan forgiveness?
It's hard to answer that without having a better understanding of what that facility fee represents. It sounds like it may be something for use of a conference room in the building or a nearby facility, and certainly, again, if it's for use of facilities and it's a fixed monthly charge, the answer would be yes. If it's a charge that isn't a fixed monthly charge, I suspect the answer would be no, because again, it's not an agreement that's in place that requires a stated rent for a period of time. We've had some related to rent, things like CAM charges or property tax escalations, and the general sense there is, to the extent that those things aren't built into your base rental payment, CAM charges and real estate tax payments probably don't qualify for forgiveness because they're not rent.
Understood. So we also have a group of additional questions surrounding the timing of certain payroll or benefit payments. Some organizations may pay benefits on a quarterly basis rather than monthly or even semi-monthly. How would that be factored into the calculation?
Again, that's a great question, and it's one that certainly the accounting community has been asking since early April when these regulations first started to come out. Under the concept of costs incurred and payments made, one would think that you have to make some kind of a payment towards those costs as they accrue in order for them to be includable. So what I've been telling clients to do is, if you can pay those, I know certain union agreements, for example, require quarterly payments instead of monthly payments. Try to make arrangements to make an exception and get those paid along the way if you can. But this is that same old thing where they're giving you the money, telling you to spend it, but they're not telling you what rules to spend it by.
Right. So the safest course of action would be, the general rule of thumb is cash out when you can do it. We've got a bunch of other questions, and just to keep this visually interesting, maybe we can throw one or two of them up on the screen so everybody can see. So I'll read this out for those who may be listening and not watching. And it's, I have a permanent part-time employee. Can I not include the salary she was paid during the forgiveness period in the calculation?
The permanent part-time employee is absolutely includable. Full-time employees, part-time employees are includable for forgiveness. If the question is, well, that person's been furloughed, I don't need them now, but I'm still paying them anyways. Again, yeah, they are includable as a payroll cost during forgivable payroll cost during that 8 weeks.
Okay, we'll throw one more question up, and then we'll continue with the presentation. Okay, for those of you who are listening but not watching, the question is, EIDL is only working with agriculture now. Do you have any sense of whether/when it will open for others? And this particular questioner said that they have received a $10,000 advance, yet have not heard anything else.
I don't know about the piece on the agriculture, if and when they're going to open up. That's a very recent change to that program. The $10,000 advance problem, it's been the whole program has been a total mystery. People put applications in, they receive an acknowledgement when their application goes in, and then they don't hear anything for weeks, and all of a sudden $10,000 shows up into their account. And a couple of weeks later, more money shows up into the account, and they're just not even aware that it's been approved. There's been really, really bad communication on that. That's being administered and dispersed directly by SBA, and we have no answers whatsoever. It's been a total mystery. Ron, I'm not sure if you have clients who've had any experience other than that.
No, Bruce. The experience of my clients has been the same. So yes, some have gotten the EIDL grant immediately. Some, the paperwork just goes in, they get a number, and then nothing happens. So, but just bear in mind that the EIDL program and the PPP program do have certain overlap. As Bruce first put the equation up on the screen, if you received an EIDL grant, that has to be subtracted by your amount of forgiveness on the PPP. And Bruce, there were also some provisions that the EIDL could be converted to a PPP, but why anybody would ever want to do that, I have no idea.
Okay.
It's it's a mandatory conversion in certain circumstances, but if you haven't received the PPP loan yet, the mandatory conversion is gone.
We're going to continue on the presentation. I'll just add, if we don't answer your questions during the presentation, we will do our best to follow up with Bruce and Ron and get those answers back to you.
Yep. Okay, good. So just kind of to wrap up this cash or accrual thing and how to deal with it. Again, we're waiting for guidance. As soon as there's better information out there, we'll be providing that information through thought leadership on our website and that type of thing. But the best advice we can give right now is just pay your normal expenses in the routine course of business. If there are things that are paid quarterly, try to pay those on a more contemporaneous basis. Hopefully we'll get that better guidance soon enough, and you'll have appropriate time to take action before your 8 weeks expires. What we don't want people to do is pay something outside of the ordinary course of business with the expectation it's going to qualify for forgiveness. I would say that if you're, like in the 8th week and you don't know whether you should pay it or not, it has to be paid, well, go ahead and pay it, but don't do it any sooner than you have to, because the longer you wait, the more likely there's going to be guidance out. So I want to go on now. I want to talk about, let's see, just trying to advance the slide here. I want to talk about calculating FTEs. Once you've determined your eligible expenses, the amount of those expenses that are actually going to be forgiven is based on your FTE ratio, or we refer to it before as your employee retention ratio. And this ratio is really important, because if your retention ratio is less than 1 or less than 100%, there will be a proportionate reduction in your forgivable expenses. There are things that you might be able to do in order to minimize this reduction, so do pay attention to this. First, let's address how you determine your FTEs. I'm probably starting to sound like a broken record, but there is no guidance on this. But most people are assuming that the SBA will adopt the methodology used by the Affordable Care Act, or ACA. Under the ACA, a full-time employee is anyone who works 30 hours or more a week. But one employee can only count as one FTE. So even if an employee works 60 hours in a week, it's still just one full-time equivalent. Then what you do is you add up all the hours worked by employees who worked fewer than 30 hours in the week, and you divide that number of hours by 30 to come up with the full-time equivalents for your part-time employees. And this calculation is going to be done for each pay period, each individual pay period, within both that 8-week forgiveness period and the base period. Then you take the average of the individual pay period amounts to arrive at your FTEs for that period. Ultimately, your employee retention ratio is the average FTEs in the 8-week forgiveness period divided by the average FTEs in either of two base periods, either February 15th, 2019 to June 30th, 2019, or January 1st, 2020 to February 29th, 2020. You get to choose which of those periods you use, and you're always going to want to pick the period with the lower of two numbers because that's going to get you the highest ratio. Somebody asked the other day, why did they choose these two periods? My response was, because they just passed laws and it made sense to somebody. But there's no real rhyme or reason to these two other than that's what's written in the Act. Now, there may be a way to have your cake and eat it too, so to speak. That is, if you laid people off between February 15th, 2020 and April 26th, 2020 in order to save some costs, but you rehire or replace those people by June 30th, 2020, you can include those rehired or replaced employees in your FTE count for the entire 8-week forgiveness period, even though they weren't there. And what's more is if you offered to rehire a laid-off worker and they reject that offer, you can exclude that person from your base period FTE count altogether. In either case, you're saving money by not having those people on payroll now, and you're not taking as much of a haircut on the percentage of forgiveness. And it's a pretty good deal if it works for you, if you had to lay off people and you have the opportunity to hire them back. Now, the last adjustment... Yes? Yeah.
Last slide again.
Okay.
Go back one slide.
Okay.
So that last bullet, that can be talking about people who are on unemployment, because some people on unemployment are possibly making more on unemployment than their present salary, and just may not want to come back, even though unemployment is limited to 39 weeks. They're getting paid and they don't have to come back to the job site and risk their health. So I assume that's part of what that last bullet's talking about.
That is part of it, Ron. There's a little bit of a catch there, because if you're on unemployment and you have an offer for employment that you don't accept, under normal circumstances, you would no longer qualify to collect unemployment insurance. There may be a little bit of an out now, and that is, I believe you're allowed to turn down a job offer if that job requires you to come into the workplace and you're concerned about your health for some reason. The best thing is really for employers just to be sensitive to this issue. And if you do have employees on unemployment currently, think about it before offering their job back, because they may be doing better on unemployment than they were when they were working full time. Okay. So the last adjustment to forgiveness is this excess wage reduction that I mentioned before. And the regulatory language on this is a bit squirrely, and the concept, assuming we even have it right, is a bit difficult to understand and to explain. The good news here is that it's not going to apply in most cases. So it only applies if you had employees who earned $25,000 or less in the most recent full quarter they worked. That would generally be the first quarter of 2020. And you reduced any of their salaries by more than 25% during that 8-week forgiveness period. So that's employees earning $100,000 or less on an annual basis, and a reduction in their pay of 25% or more. It also won't apply even if you have that situation if you hire those people back by June 30th, and that's assuming that the pay cut occurred between February 15th, 2020 and April 26th, 2020. So it's not like you can't cut somebody's pay now and just restore it later. You would have had to cut the pay previously. So as I said, this is a bit confusing. Please, access the presentation. I think if you take a look at it, you can walk through it on your own later, and you'll understand it. I also want to take a moment to emphasize that you can reduce the salaries of employees who earn more than $25,000 in the most recent quarter, or whose salaries are over $100,000 a year, without any penalty in terms of the excess wage reduction penalty. So now that I've probably totally lost you, I'm going to go through a quick example. So let's say you have someone whose salary was $100,000 a year. They earned $25,000 in the first quarter of 2020. And then on April 1st, you reduce their salary by 30% to $70,000 a year, or it's $10,769 for that 8-week forgiveness period. Since the maximum allowed reduction without penalty is 25% and you reduce their salary by 30%, the excess reduction is 5%, the 30% minus the 25%, or on a $100,000 salary, that's $5,000 a year. Broken down to the 8-week period, this amounts to $769, and that's the amount by which your forgiveness is reduced for this excess wage reduction. Again, it's kind of confusing, but if you access the presentation, I think you'll be able to follow it and follow the math as well. So now what we'd like to do is get into some planning considerations. And I want to caution you. I'm sorry, yes.
Yeah, that's okay. I want to take a couple of questions. Quick comment on some of the stuff that you just went over. And that is, there isn't absolute equivalency between the size of the loan and the amount of forgiveness. You could have taken a loan, which is still a pretty good deal, and get partial forgiveness of the loan as long as you qualify and as long as it meets the formula that you've just described. So if you haven't applied yet, apply for the maximum amount you think you're due, and then you might not get it all forgiven, but you'll still get some good portion of it forgiven. So I want to take a couple of questions that we can throw up on the screen before we go into this last section. Okay, pretty self-evident, and that is, what is the operative date for the end of this period if 8 weeks following the loan disbursement ends after June 30th? So let's just say you got your loan last week.
The forgiveness period is 8 weeks or 56 days from the day that you get the loan. June 30th, it's the last day you can hire these people back, but it doesn't matter if the 8-week forgiveness period goes beyond June 30th. In fact, the way the law reads, June 30th is the last day you can both apply for a loan and receive a loan, which isn't really practical. But as long as you receive the PPP loan by June 30th, you still have 8 weeks to spend the money and have it forgiven. But some of these provisions about the hiring them back by June 30th obviously become moot at that point.
Okay, let's throw one more question up on the screen.
Okay.
What documentation show employer intent to rehire an employee?
Yeah, I'm sorry, Mike. I didn't get that, and I can't. It's too small on my screen for me to read.
So, if you intend to rehire an employee, what documentation will be sufficient to show intent?
The guidance says that you have to have a bona fide offer letter and a written rejection. An email on that rejection is fine.
Okay, thanks. All right, let's go on.
Okay.
Let's continue.
Okay, so now we're going to talk about some planning considerations, and I want to just caution you again that these planning considerations are based on what we know today and our understanding that forgiveness is going to be granted even if you don't spend 75% of the entire loan proceeds during that 8-week forgiveness period. Frankly, that concept I mentioned earlier of not allowing forgiveness for partial spending It just makes no sense in context of the overall act, but there are some people out there that believe that's the way it works, so please be forewarned. I also want to emphasize that when it comes to planning, we don't believe that you should plan to maximize loan forgiveness. We think you should plan to do what's best for your business and then maximize forgiveness within that context. For example, if you run a restaurant and you're currently running a curbside pickup or home delivery business at 20% of your normal volume, it certainly doesn't make sense to bring everybody back on payroll just so you can have your loan forgiven. And besides the fact that many of these employees may be making more on unemployment than they were when they were working, you're going to need that money to run your business when you open back up. It's likely going to be months or more before that business returns to pre-pandemic levels. And the PPP money with a 1% interest rate, as we said before, represents pretty cheap capital. So again, start with what's best for the business and maximize forgiveness from there. So planning tip number 1, pay attention to the FTEs. A reduction in FTEs actually has a double impact on forgiveness. First, you don't spend the money, and second, you recover a reduced percentage of what you do spend. So if you go through the math, a 20% reduction in force actually equates to a 36% reduction in forgiveness. Rather than lay people off, you'd be much better off giving people or cutting salaries across the board by 20%. This way, you'll reduce or you won't impact that forgiveness percentage. And if you already did reduce headcount and that reduction was done between February 15th and April 26th, try to rehire or replace as many of those employees as makes sense for your business by June 30th. Again, you can include those people in the FTE count, bring that inclusion percentage way back up, and that'll have a really significant positive impact on the amount of the loan that's forgiven. Next, and we don't know if this is going to be allowed, but consider running a short payroll just prior to that 8-week forgiveness period. Just to be safe, make sure that the pay date is actually on or before the last day in that period. I know sometimes you run a payroll as of a certain date, but it's a day or two later before that transaction hits your account. We want to make sure it hits your account within that 8 weeks. If you run a semi-monthly payroll, this could be a must in order to pick up that 4th pay period within the 8 weeks. We're waiting for guidance on this, but it doesn't seem right that those running semi-monthly payrolls are going to be miss out on almost 2 full weeks of forgiveness. Now, some people have asked about accelerating or paying bonuses in order to increase payroll costs. Again, if this is outside of the ordinary course of business, we don't recommend it. There are a few reasons for that. But if the bonuses represent hazard pay for frontline workers who are taking risks by being at work, like, say, healthcare workers, cashiers, factory, warehouse workers, it's probably not a bad idea to pay them a little bonus as long as you keep that all within reason. It's certainly normal business practice and well justified in these times. Next, be sure to pay attention to the new guidance as it comes out so that you have the opportunity to maximize your payments for health insurance, rent, and retirement contributions. As we said, it's been a constantly evolving environment, and you need to stay informed. Certainly, you're welcome to check back our website, our COVID-19 Resource Center. We keep people up to date on everything that's going on with the PPP. And again, I want to emphasize, don't do anything outside of the ordinary course of business that might be construed as abusive. The further outside those lines you go, the more likely it is that you're going to jeopardize forgiveness altogether. Our last point, and it's a very important one, is to keep good records. You're going to need copies of your payroll registers and the worksheets that you use to adjust for salaries over $100,000. Check with your payroll provider on this. They may be able to provide you with this report, but be careful not to just accept that report blindly. if you recall, there were a lot of errors up front with the early reports that they generated for determining the PPP loan amount. Also, keep copies of your payroll tax returns, all your invoices for rent, utilities, loan interest, and any other payments you make, as well as details of retirement plan contributions. And make sure that you have available copies of any lease and loan agreements, because the banks may want to see that. The forgiveness application itself is submitted to your lender, and it's the lender's responsibility to review the completeness of the documentation supporting that application. So undoubtedly, just as with the application process up front, different lenders are going to have different requirements, and there may be some differing interpretations of rules from one lender to the next. Ultimately, it's important to understand it's your lender's responsibility to approve for the forgiveness application. So certainly comply with everything they ask you to do. And they'll have 60 days to approve that application once all the required documentation is submitted. The last point here is to open a separate checking account. This isn't necessary, but it is being recommended as a best practice, and it may make record keeping easier for some of you. With that, that wraps up our slide presentation. So I don't know, Ron, do you want to pick up, or should we just open it up for more questions?
Just a couple of points, Bruce. So the actual forgiveness application, at this point, we don't know whether that forgiveness application is going to be an SBA form or whether the banks are going to put together their own applications. Is that correct?
That's correct. There's no form out yet for forgiveness. I suspect that the SBA is going to come up with some very simple form, and the banks are going to supplement that with their own information requests.
Right. So,
guys, when is that process going to start? The forgiveness process, to your best knowledge?
Yeah, that's going to start. There are businesses that have had these funds for close to 5 weeks now. Some of the earliest applicants, they got their applications in right on April 3rd. They were at the very front of the line. Typically, they were the larger borrowers that the banks gave some priority to, and they may have gotten their loan proceeds by April 10th or April 12th. So they've been spending that money for close to 5 weeks. So I would suspect in about 3 or 4 weeks, you're going to start to see the forgiveness process start in earnest as companies start preparing the forgiveness applications.
Okay. We will take 1 or 2 more questions. We have been running over, so I don't want to keep everybody too much longer. But before we get to the questions, just to remind everybody that we will make a presentation available on our website, westchester.org, and we will also include a link on the presentation of this video, which you can review on Facebook, LinkedIn, or on YouTube. So let's throw another question up on the screen. It reads, if we're just making the 75% of the total loan, if we gave the difference back now, would that matter?
You cut out, if they gave the difference back now, would that matter? Is that the question? Yeah.
Correct.
No, it wouldn't matter. I don't know why you would want to do that. We're recommending to our clients that they don't do that. We don't know where things are going. Businesses in New York and Connecticut are starting to open up on some limited basis. Things are beginning to move forward, but there's so much uncertainty out there regarding how how businesses will recover and how each and everyone's own business is going to do. So, you're talking about 1% money. It doesn't really cost you much to hold on to that money for, 8 weeks or 16 weeks or 24 weeks. So we don't see any reason to give that money back now.
We're going to take one more question before we wrap this up. Can we give staff a bonus to meet 5%?
Again, bonuses, that's one of those areas that you really need to exercise some caution. The act is silent on it. The SBA guidance is silent on it. The general sense out there is if you don't ordinarily pay a bonus this time of year, you probably shouldn't pay a bonus. We'll see what the final guidance says, but if you do pay a bonus, keep it small and try to correlate it to work that's actually being done during this period. As I said before, like hazard pay for frontline workers.
Okay. Let's throw up the banner for our platinum sponsors to thank them once again, and then Bruce and Ron for some closing remarks. Thank you, the platinum sponsors, the WCA platinum sponsors, for making this important work possible. Okay, guys, any closing remarks before we wrap this up?
Ron, you're the closer.
Michael, once again, I'm the closer. Once again, thank you for having us. There's a couple of major takeaways from this presentation. The first takeaway is if you've received a PPP loan of greater than $2 million, you do need to be concerned about certifying need for that loan. We've developed some proprietary materials. We have a work program for our staff, and we have some templates to allow them to help our clients with projections. So if that's something you'd like us to help you with, our contact information is on the last slide. Feel free to contact us. And then we also have a calculator for forgiveness. You've got to keep your eye on this forgiveness calculation. I mean, we've got once again a proprietary Excel template that we've been using for our clients, but I think you kind of need to do this week by week. Keep your eye on the 75% of payroll costs versus the 25% of non-payroll costs, and also keep your eye on Bruce's planning tips. I think that's incredibly important. But otherwise, just my closing comments. We just hope everybody stays healthy and safe and stays smart during this pandemic. And we wish everyone the best. Bruce, any closing comments?
No, I just want to thank everybody for participating. I hope what you heard today was helpful, and thank the Westchester County Association for having us on.
Okay, and on behalf of the Westchester County Association, we all recognize that this is an incredibly difficult business environment, and we're working very hard to try and give you useful information and be a resource for helping your businesses through this crisis. So I want to thank the guys at PKF O'Connor Davies for putting on this incredibly valuable presentation. You can review it at your leisure on our website, on all the social media pages. Their PowerPoint presentation will also be made available. And if you want to learn more information about us, you can find us at westchester.org or find us on Facebook and LinkedIn. So again, thanks for tuning in. Be healthy and be safe.